For private sellers?
For private sellers, for the consumer, how do we bring that listing price lower?
So ultimately, if there's no fees, then it's up to the consumer if they want to sell that item for less. But ultimately, we just want to get more listings on, and that's why we've made it easier. So rather than listing 1 or 2 items, because it might have taken you a longer time before, we've removed some steps to make it easier. So hopefully you're more encouraged to go and clear out your wardrobe, or if you're moving house, go and sell all those things on eBay. So, you know, as I say, rather than go to landfill.
Less is more. Get rid of it. Get it out of the house. Firmly in favour of that. Kirsty, nice to see you. Thanks for stopping by to see us. Kirsty Keegan, General Manager, eBay UK. Thank you very much indeed. Talking of car parts, we need to talk about what is happening in the auto sector right now. Harold Hendricks is going to be joining us, Managing Director of Autos Research City. He's going to be coming up next to navigate what is a bumpy road for the auto sector right now. Have you seen the car sales data this morning out of France? Again, super weak. We'll talk about that next. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like just around 50% of our ticket sales are 45 years and older and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. All right, so all of a sudden we're seeing these data points coming out going, my gosh, we're owning this space.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Age of Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl,
I
right?
can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. We are 44 minutes into a European trading session that shows modest gains. We weakened a little just half an hour ago, but actually back into positive territory only just on the STOXX 600. In terms of what we are seeing under the hood, though, European automakers in focus this week after Volkswagen, Stellantis and Aston Martin all delivered warnings of a bumpy road ahead for the sector. Our next guest says the caution is unsurprising. Harold Hendricks is Managing Director of Autos Research at Citi and joins us now on set. Harold, nice to have you with us. So take us through, I mean, big picture here. There seem to be different issues for different car makers depending on where they're exposed, and what can you tell us that unites them all? I mean, for Stellantis, difficulties in North America, VW citing difficulties in China, Aston Martin talking about supply chain problems. I mean, what is the uniting problem that they are all facing?
The uniting problem is really that they're all coming from a really high base during COVID, right? Overall, consumer demand was very strong during COVID. They had production problems, so they couldn't produce, what the consumer wanted to buy. So they had a lot of pricing power for the first time in, literally my career, over 20 years.
Yep.
Car companies have never had that much pricing power. So they were selling very highly priced cars at very, very strong margins. And I think they'd all extrapolated as if that would continue forever, and it just hasn't. So China clearly much, much weaker this year. Because they can't sell in China, they're selling more cars in the US, and so that's causing US discounts to start to go up. And now the last thing is in the summer, clearly orders in Europe have slowed very sharply, right? Europe was up nearly 5% in the first half of the year, was flat in July, minus 17% in August, and then this morning we've had France down 11% in September.
Yes.
So they were hoping for a much stronger second half in Europe, and that hasn't happened.
But putting it in the context of COVID makes it sound like we're talking about some kind of normalisation. But given the move away from, internal combustion engines to EVs, that doesn't feel like we're in normal territory, and that seems to be wrong footing a lot of people. So is this normalisation, or is this something much bigger?
I think you're right. I think there's two levels, but actually most of the problems we're talking about today are about normalization, right? The market in Europe hasn't come back to pre-COVID levels. The market in China is just more difficult than it used to be. And then pricing has just been too high. People forget, but car prices across the world, if you look at the ASPs for these companies, they're up 30-35% in 4 or 5 years. Our salaries are not up 35%.
Yeah.
So, in real terms, people cannot buy as many cars. And so the European market now is sitting at about 13 million units. We're stagnating at 13 million units. Pre-COVID, it was 15.5. We've lost 2.5 million units. If you're a car company, Volkswagen, 26% market share, you've lost 600,000 units. That's nearly 2 huge factories, right? And so they can't fill up the capacity anymore. So the industry is really, really different. And that's even before we go to Chinese competition. That's before we really transition to the EV situation, where again, that's super difficult. The cars are too expensive. The consumer doesn't want to buy them. Governments have no money for stimulus. How are we going to sell all these EVs, right?
Politicians are beginning to get very nervous. You're hearing that across Europe. Germany is the epicenter of the action. The expectation is that we're going to be seeing some of these targets removed or pushed out. Is that the silver bullet here? Is that going to make much of a difference, or are we delaying the inevitable?
Yeah, really, really good question, and a really, long, hard discussion. We last week changed our view from a 30% chance of a change in the European CO2 targets to now our base case is that they will. For exactly the same reasons as you're talking about. I think the European politicians, we had 2 horrible elections, frankly, in France and Germany for the governments that were in power. I think those politicians are starting to understand that, they're going to lose their jobs.
Yep.
So finally things I think are changing. And so I think the first thing will be that the regulations for European CO2 will be delayed to give us a much more sensible, frankly, time frame for the companies to be able to meet those targets. But then, also we need more stimulus. If you want people to drive BEVs, you have to stop them driving ICE cars. Why are there not more city bans, for example? We've got toll roads everywhere.
Because there isn't the infrastructure to go with that. There isn't the industrial policy that wraps around all of this.
Yeah, look, we don't have a strategy, a total strategy to build.
Just stop there. We don't have a strategy. Maybe that's where we need to be thinking about it.
Yeah, that's really, really right. But the really disappointing thing, I think, for a European point of view is, we were ahead on the CO2 side. We saw that coming. We were first to push people towards BEVs, and we're not capitalizing in terms of the industrial base. We're not capitalizing in terms of battery factories, investments, all of these things. These companies should be winners in the BEV space, and right now they're not.
How much pricing power do they actually have? If we're talking about targeting American consumers in the absence of anyone else, how much lower can the prices go? Can they at all?
Yeah, you've framed it very nicely. So at the end of the day, pricing is essentially a function of the profitability, right? So if you're sitting at 10-12% margins, then pricing is a little bit easier, and cutting prices by 3 or 4% is possible. Once you're down to, Stellantis yesterday talking about very low margins in the North American market for the second half of the year, at that stage pricing becomes much more difficult, right? People forget, if you give away 200 basis points of pricing, that's 20% of your normalized, maybe even 25% of your normalized profits gone.
Yeah.
Right? Pricing is very, very sensitive. So I think we're coming up against a situation where it's going to get more difficult, but the overall American market is still getting more difficult. And just to give you an example, before COVID, we were at 13% average discount, dealer discount, for the average car. Today, the average market is still at 7 or 8. So we're not yet at pre-COVID levels in terms of discounting. Given where inventory is, given people like Stellantis and stuff like that, I think pricing could get a little bit worse.
So what does that do to the design cycle and the innovation cycle when it comes to releasing some of these new models?
Yeah. Well, so two things on that. Firstly, the Chinese are really showing us the way, right? So, and generally speaking, the legacy car companies have had, new model cycles, 6 or 7 year, model life cycles, right? The Chinese are down to about 2 or 3 years, so they've really sped things up very, very significantly, and especially with the new technologies, software, hardware, electronics going into the car. The life cycle has to be shorter because the technology gains that they're making in those areas are so much faster, right? If 6 or 7 years is a lifetime, in terms of some of those products. For the legacy car companies, look, it's difficult. Profitability was super high last year. They all increased spending. CapEx and R&D spending is really high this year. Now the profits are coming down, they're going to have to look at exactly where they want to invest, and they may not have quite as much to invest for next year.
Harold, you mentioned how there's not enough industrial strategy in Europe. It seems to get a lot of mention. We talk about it a lot, and we live in a much more geopolitically interventionist world with the Inflation Reduction Act in the United States. So the precedent globally is there. What is it? What are the dots that are not being joined up here? What do the car companies tell you that they need to see?
Well, again, what does Europe actually want? Right, one of the things is we need consistency in policy, right? And so, putting these very stringent targets in for CO2 in the very short term and then moving them is also not helpful. These companies have been putting 80, 90, 100% of their investments into pure BEV, but they were hoping for a much more supportive environment that would actually generate the demand for EVs that we were all forecasting, which clearly is not happening. So that's on the one side. So we need to do much, much more for the consumer if we want them to go there. But secondly, on the industrial side, just like the Americans, if you want European batteries, then enable the Europeans to build European battery factories. And if that means that we end up putting tariffs on China, so be it. And that's what the Americans have done, right?
It's all the bad news in the price.
We think that, for this year, generally speaking, the auto sector tends to be strong. November, December, January, investors tend to buy laggards at the end of each year, hoping for a better year next year. With the interest rate cuts and stuff like that, I think people will hope for a better year next year. And I think that could build a little bit of hope value back into the car sector for the last 3 or 4 months of the year, particularly given that we're really rebased in terms of, short-term earnings expectations. So I think earnings could still be lower in 2025, but if we have 3 or 4 quiet months now after what has been a tumultuous 2 or 3 weeks, then I think there is some scope for recovery if that, overall economic sentiment can improve a little bit.
I feel like what I'm hearing is policy matters at the end of the day, and I'm wondering how much of the story comes out of the U.S. elections and, of course, what happens at the EU as well. Harold Hendricks will lead the conversation there, Managing Director of Autos Research over at Citi. Thank you so much. Let's talk about another area that's largely going to be affected by the U.S. election, of course, the geopolitics in this region as well. We did get headlines from the new NATO chief, Mark Rutte, speaking about really the need to invest. It's, again, this theme we've explored not just through the show, but I want to say for years now in Europe as well, saying they'll be able to not only invest more, but try to close capability gaps, and we'll be able to work with both President Trump and Vice President Harris as well. Bloomberg's Max Ramsey took a deeper look at the challenges the new Secretary General faces.
He's one of Europe's longest-serving politicians, known for his positive nature and ordinary lifestyle. Mark Rutte used to cycle to work during his 14 years as Dutch Prime Minister. Now he's heading for one of the toughest diplomatic assignments that exists. With war in Ukraine, the redefinition of Europe's defense, and soon, a new US administration. Compared to his predecessor, Rutte is expected to be more hands-on.
And a lot of good things are happening.
He managed to keep former President Donald Trump on side in his last term, despite his fiery criticisms of NATO.
Let's stop whining and nagging and complaining about Trump, whether he might return or not.
His ability to compromise is seen as key.
Mark Rutte is a pragmatic coalition builder. He will need a lot of that because NATO is very much about coalition building.
He's been an important figure in securing support for Kyiv, influenced by the Malaysia Airlines MH17 plane crash in 2014 in Ukraine. It killed almost 200 Dutch citizens, and the government blamed Russia. Now he's led the way on sending F-16s to Ukraine, bolstering his reputation as a political force to lead the alliance through uncharted waters.
Bloomberg's Max Ramsey there talking about the change of power over at NATO. Mark Rutte taking over the reins from Jens Stoltenberg, again, as the head of NATO. Let's talk about what else we're going to watch out for today on the agenda. 10 a.m. UK time, we do get that Euro area CPI data as well. But I think the highlight for today is going to be at 2 p.m. Michel Barnier's policy speech is going to be coming up. There's a lot to debate there, especially when we're talking about the budget, migration, not to mention the politics with his own country. We've got Nike earnings after the bell as well. And not to mention what's going on over the States. The US VP debate, 2 a.m. UK time if you're awake.
Absolutely. And we will certainly have coverage of that this time tomorrow, won't we? It strikes me, thinking of the election, Mark Rutte now joining NATO, taking on that role, saying they'll be able to work with both Trump and Harris. We heard from Larry Fink earlier on in the programme, downplaying the relevance for investment allocation of the US election, talking about how, asked do you deploy capital differently under Trump or Harris? And he just said, well, at the margin, but he thinks that maybe we exaggerate a little what difference that will make.
Those are two different conversations. The executive in the States has the authority when it comes to foreign policy in a way that it's different, therefore, for Rutte to handle. When you're talking about investment, everybody I'm talking to at the moment is telling me they expect that actually we're going to see stasis. You may see one party taking the House, one party taking the Senate, maybe a different, kind of one of those two taking the White House. There's going to be gridlock. From an investment point of view, that sounds...
That's what Larry Fink is.
Precisely, that's the Larry Fink kind of world that we're moving into. But from a foreign policy point of view, with tariffs and all that other stuff, and what happens in Ukraine and what happens in the Middle East, that's where the difference could be.
Well, this is also where is tariffs the right approach, and this is, I think, what's crucial about the Harris administration as well, if we do get one, is largely a continuation of what might be Biden's policies. That includes maybe the extension of tariffs on someone like China, but quotas or other kind of mechanisms on places like Europe. Remember, there's still steel quotas at the moment hanging over Europe, and that's one of the first things that Europeans have to figure out with their U.S. counterparts. There's a lot to digest, 37 days till the election, lot to play out between now and then. That does it for the opening trade. The Pulse is up next. I believe we're on the ground in Berlin, live at the Berlin Global Dialogue. Stick with us. This is Bloomberg.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities.
Who face bigger challenges next?
One's going to keep me welcome.
This is a story as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized
With
finance.
the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials
the
accountable.
transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Dock walkers walk out of every major port on the US East and Gulf coasts, threatening the world's largest economy weeks before the election. Israel says it has begun, quote, targeted ground raids in villages close to the border in southern Lebanon, despite international calls for restraint. Plus, Fed Chair Jerome Powell says he's in no hurry to lower rates, while reiterating the United States economy remains on solid footing. Welcome to the programme, everybody. Let's take a quick look at what is playing out in front of us in terms of the European session. We're sort of inside of the flat line here. The FTSE 100 up by 0.4%. The DAX a little stronger. The CAC Carol's on the back foot today. We see some of the luxury names under pressure. We've seen a downgrade to some of the luxury players from one of the banks, and that could be weighing on Paris just a little bit. Broadly, then, treading water overall for European equity markets. In terms of individual assets we're focusing on, this is the futures picture for the US. This, the epitome of treading water, really waiting for some direction here, watching the strike action taking place in the ports in the on the east coast of the United States and down into the Gulf as well. Also watching geopolitical developments, of course, and with that in mind, quickly checking where we are on Brent. We're actually a little weaker now. We did tick up a little overnight on the Brent price, but now at 70.86. European gas futures also a little bit weaker, and dollar yen dictating the direction at least a little of the Nikkei, as we saw in Asia trading overnight. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in London. Francine Lacqua will be with us this hour. She's at the Berlin Dialogue, the Berlin Global Dialogue. We've already heard her in conversation with Larry Fink this morning. Plenty more coming to us from Francine and that dialogue as we go through this programme. Let's turn to geopolitics. Israel says it has begun what it describes as targeted ground raids in southern Lebanon, defying international calls for restraint. The military has been striking targets in villages close to the border that pose what it says is an immediate threat to communities in northern Israel. Let's get more now with Bloomberg's Stuart Livingston-Wallace, who can bring us up to date from the region. Stuart, an update on what we're seeing overnight from Israel and the objectives they describe attached to this operation.
Yeah, good morning, Anna. So at the moment it's very hard to tell what exactly is going on. We know we've seen some reports of explosions on those villages, as you mentioned, along the border, but there have also been similar incidents along the coastal areas and again in Beirut. So just to remind everyone, this sort of comes at the tail end of a couple of weeks of really very intense airstrikes in Lebanon. And that's really aimed at two things. One is to eliminate the Hezbollah leadership. And so far, Israel says it's eliminated something like 10 out of 11 of the most senior leaders, and secondly to degrade the weapons stockpiles that Hezbollah has across. So most of that has been focused on the Bekaa Valley and then the southern suburbs of Beirut, because those are the Hezbollah strongholds. But what you've seen this morning, I think, is a realization from Israel, or acceptance from Israel, that airstrikes alone are not going to be able to do the full job in terms of eliminating that threat to its citizens in the north of Israel. So fundamentally, Netanyahu, the Israeli Prime Minister, expressed one of his war aims is to be able to move his citizens back into the north of Israel. So they've evacuated from there for many months. And that is really fundamentally what they're trying to do here. The real risk is how long they have to stay to get that done. And really, they may get bogged down and find themselves back in the same situation they were a couple of decades ago, where they had to effectively stay in the southern Lebanon for years and years. That is not the intention here. That is clearly not their stated goal, but that is one of the risks.
Stuart, thank you very much. Thanks for the update. Bloomberg's Stuart Livingston-Wallace with the latest on what we're seeing developing in Lebanon. You can follow what is happening, the latest coming to us from the Middle East on the Bloomberg Top Live blog. That's on the web and on the terminal with the latest on the Middle East situation. TLIV Go is the function to use on the Bloomberg terminal, or you'll find it on our website. Let's just get to some breaking corporate news coming through, and this coming from Lufthansa, the CEO speaking at a press briefing. He's talking about the gap, says that the gap between the group and Lufthansa Airlines has widened, says overall traffic figures have been strong, but then makes that point about the gap between the two, says that the namesake airline continues to hurt earnings. So a focus on the performance of Lufthansa there. I saw earlier on overnight they were talking about their Middle Eastern operations and extending their suspension of Beirut flights to November 30th. But the subject of this briefing seems to be around the performance of the business. That does not seem to be denting the share price right now, up by over 3%, with the oil price down 1%. Perhaps that has held sway. Let's talk about macro policy, monetary policy. Fed Chair Jerome Powell has emphasised that the overall US economy remains on solid footing, setting the table for further cuts.
Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance. But we are not on any preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting.
I'm joined now by Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, for thoughts on what this means for markets. Karen, good to see you. So did you take anything new from Jerome Powell yesterday? I mean, some reports I was reading said, quote unquote, he was a tiny bit hawkish. I'm not sure what a tiny bit looks like to you, whether that's how you describe it. But was it a sort of material update, or is it steady as she goes for you in terms of cuts?
I think the steady as you go part is this whole narrative the Fed have created around our central projection is our war against inflation is won, and therefore we can get back to neutral as quickly as possible. And he reiterated this point about neutral. The Fed, I would say foolishly, give us an assumption of what neutral is. It's much closer to 3. So he's sort of painting this idea that we don't need to be on the brake anymore, so we're just going to ease off and we can get there as fast as possible. Perhaps the slight angle, which is the little bit of hawkishness, is this sort of two-sided risk, and also perhaps that they're not in a major rush. You know, the difficulty when you start off with 50 is that the market, you know, how you control what the market expects about the pace going forward. Yeah. So maybe they're just trying to bring a little bit more gradualism into some of the forward expectations, where there's still, you know, an awful lot of very rapid cuts priced.
I don't know whether it's, you know, when is the right time to look back at that 50 basis point cut and say, was it the right thing? When we need maybe more benefit of hindsight. But when you look at that now, did it make sense to you at the time? Does it make sense still that they started with 50?
No, if I'm honest. I mean, to me, they really started cutting in December. Back when Jay Powell gave us that significant pivot, really gave us the statement that they felt comfortable they were winning against inflation. If you look at what happened to financial conditions from December, they already started really improving. So credit spreads tightened significantly, mortgage rates fell. So the sort of impulse of monetary policy through the economy was already being felt from December because the market priced these lower rates. For that reason, I didn't think they needed to particularly rush. I felt that, you know, you always risk creating a sense of panic. And, you know, some of his statements last night were, look, everything's fine, the US economy is fine, so maybe again he's trying to reel back a little bit on that. I didn't see the rush and the urgency, given it was already sort of that 100 basis points was already priced. But, you know, you could argue that they're being preemptive, they're getting ahead of the game, they're not taking any risks with growth, and that's why the stock market loves it.
Yes, let's focus a little on Europe and how Europe should respond, because, of course, you know, monetary policy setters, they don't want to just follow each other, but they also don't set policy in a vacuum.
Yeah.
So what does this mean for the ECB then, and with your focus on allocating around European assets?
Yeah, I think they should just get cracking. You know, to me, the US globally we had a supply shock. We had a cost shock to inflation. But the fiscal response in the US was so massive that the US also had a demand shock. So the Fed were really right to have to lean hard against that. I think in Europe, yes, you also have to lean against a supply shock, but when it's really clear it's passing through and headline inflation is down, then you start easing. And I think the ECB really need to get cracking. The economy is weak. Just look at the data we're getting out of Germany. And I think now that we will see wage inflation follow headline inflation down quickly. It's a very indexed type of wage negotiation process in Europe. So I think the ECB should get moving now.
Yeah, so what opportunities, with that as the backstory, are there opportunities to invest in Europe at this point, Karen? Is it attractive? I mean, we saw, yes, the PMI data confirmed today for Germany and for France, that very negative story that we saw coming out last week.
Yeah, I mean, we were pretty bullish on Europe at the start of the year for two reasons, one of which is proving right and one of which is proving wrong. So the reason that's proving right is that we felt that we were finally going to get our post-pandemic consumer bounce, headline inflation falling, real wages improving, confidence rising, and that broadly is playing out. The part of the story that is not is manufacturing. We felt also we were going to be on a global goods upturn and Europe was really going to benefit. And that isn't playing out. Global goods demand is still very weak. The weakness of China, I think, is part of that story. We felt that China would have been on a better upturn. So that's proving a bigger drag. But, you know, when it comes down to asset allocation, it's always about what's in the price, not just what the outlook is. And I think if we look at the historic low valuations on Europe, then that suggests there's an awful lot of bad news in the price. And I also think that for investors should be thinking about how to diversify away from the concentration of tech in the US.
Yeah.
And therefore, I think Europe is a good place to go.
Does that take you to somewhere as beaten up as the European auto sector then? I mean, there's certainly a lot of bad news in those prices after the week or weeks that we've had of negative news flow.
Yeah, I mean, there's something else going on here, which is partly related to this goods. I think Europe really is at a bit of a crossroads, because I think Europe needs to wake up and realize there's two things the rest of the world is doing that we're not doing. And we think it's because we're being sensible, but we're just destroying our domestic industry. So the two things we're doing are we are, you know, focused on saving the planet and climate regulations and reaching net zero. But when the rest of the world isn't meeting you on those regulations or those carbon pricing, it's really penalizing domestic industry. The other thing the rest of the world is doing is handing out subsidies left, right, and centre. And we know that Europe was very hesitant to follow the Inflation Reduction Act. We're much more worried about debt levels here in Europe. The rest of the world isn't, you know, so it's like going to a party and, you know, behaving yourself. You know, it's the right thing to do. You're not going to have a hangover in the morning, but the rest of the world's having a better time. So I think Europe really has to think about how it's going to support domestic industry when the rest of the world is doing different things.
Okay, Karen, nice metaphor to leave it on. Karen Ward, the Chief Market Strategist at JP Morgan Asset Management. Thank you for being with us. Coming up on the programme, as promised, we will be live at the Berlin Global Dialogue. Francine Lacroix will be speaking to KKR's Philippe Fries about investment opportunities in Europe. That's coming up next. This is Big Bang.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, good morning, everyone. From the Berlin Global Dialogue, I'm Francie Lachman. Now, despite the economic doom and gloom in Europe, investors are still looking for opportunities. Now, some of the biggest names in private equity are here at the Berlin Global Dialogue, including Philip Freise, the co-head of European private equity at KKR. Philip, as always, thank you so much for coming on. Now, look, M&A in private equity has frankly not been easy. How do you read the situation?
Francie, first of all, thank you for having me. Good morning. Well, as you pointed out, the period between 22 and 24 in the summer was a rather slow period. However, we have experienced a significant uptake now. I think we are up 40% year on year. So as we had previously discussed, that lull would at some point be followed by more activity, and we're seeing that right now.
So where do you see opportunities? And is there still a price mismatch? I remember speaking about this with you as if it was yesterday. Has the buyer's expectations come down?
Well, KKR is constructive on Europe. This year alone, we have invested 25 billion euros here on this continent. Telecom Italia in your country, but also in private equity, a significant equity deployment of 6 billion euros so far this year. And where we see the opportunities, this continent has unprecedented disruption. We have a war, we have an energy transition, we have a technology disruption on a massive scale, and lastly, a generational handover, if you will, that hasn't been precedented here. And people are open for private equity to help them with all of these challenges. So as KKR, we really are positive on partnering with our, potential targets to help them, cope with these challenges.
So family-run businesses
Yes.
in certain sectors, or just opportunities that look cheap?
So I think, as you pointed out, people are negative on Germany right now. I would be a bit more positive. The innovation power of the German Mittelstand, so family-owned companies, is unparalleled. They have built global niches. Yes, they need to change. Yes, they want to change. But yes, they are also open to work with us. So I'll give you an example. We have just partnered with OHB, the kind of noteworthy German space company in Bremer. The family had 70%, 30% was public. We now took it private. They are still 70%. They didn't sell a share. We took the 30%. And we will help them get into the future in terms of the space economy. They want a partner that is more active than the public markets would be. So to answer your question, it's tech. Space is only part of that tech ecosystem. It's energy transition. Fiesmann did that massive deal with Carrier where they sold their firm, but they are now going back in. They've partnered with us on Encarvis, which has 190, new energy.
Phil, when you look at Germany, it's seen as a segment of Europe right now for a number of reasons. We saw, for example, Volkswagen looking at shutting factories, Intel actually not putting that investment straight away that it promised, flatlining growth, if anything. Do you see more opportunities in Germany than elsewhere?
It's a wonderful reminder. Last time Germany was called the segment of Europe was 2003. And you remember the reforms, the change that was deployed. We helped with that at that time. As you remember, we did many German deals, DMAG, -1 plastic machines. I just mentioned Encarvis, the energy transition. People call it challenged. I wouldn't go as far as calling it the segment of Europe because of that energy transition. On the current trends, in 2030, Germany is going to be through with it. But it's a significant investment opportunity which we're helping. I wouldn't call, you saw the deal this morning where ADNOC bought Covestro.
13 billion, so it's
Yes.
not an insignificant deal.
Indeed. People wouldn't invest in Germany if there wasn't opportunity. It still has all the advantages, but it's much more open to change now. It wants entrepreneurial capital, so it's, in our mind, a very attractive opportunity.
How much money do you have to deploy here? I know that you wanted to double maybe some of, I don't know whether it's deals or also staff in Europe to try and find the best opportunities.
Well, KKR has invested in Europe for 25 years. We have not only a private equity business, we have an infrastructure business, a credit business. We have a high net worth, fundraising business. We are all over Europe. We have significant funds in private equity alone. Unlike others, we have a standalone European fund, and therefore the capital to be deployed here in Europe is not a bottleneck for us. In fact, we want to invest more.
Okay, Philip, thank you so much. Philip Freiser there, the co-head of European Private Equity at KKR, stays with us, and we'll talk maybe a little bit about private credit and some of the other opportunities. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back, everyone. We're in Berlin, still with Philip Freiser, the co-head of European Private Equity at KKR. Philip, thank you so much for sticking around. Are you seeing increased pressure from investors to actually return capital to them?
Well, we just returned about the impact of this unprecedented volatility. It actually has created now an opportunity to deploy more capital. We are up 40% year on year. But indeed, because of the uncertainty, the IPO markets are still shut, pretty much. There are some timid attempts now for companies to go public, but not at the scale that we are used to. It's still down more than 50%. As a result of that, everybody is finding alternative ways of returning capital. It's certainly up as well in terms of the return of capital, but it's more through longer-term hold periods, selling minority stakes, and yes, strategic buyers also coming back in the market timidly. Indeed, the liquidity that we are seeing more on the buy side is not matched by, liquidity on the sell side. So indeed, that's where we will see more activity I believe once we have some of the elections behind us, 25, we'll see more activity.
I mean, is that a catalyst? Would that be a catalyst, or do you need something for animal spirits? And does that go through also interest rate cuts?
I think animal spirits always happen. We just talked about Germany, right? If it was true that Germany was a challenge, why do we see all that activity right now with Commerzbank, with Covestro, with our industry being really active? It's because that type of turmoil creates opportunity. So indeed, 25, I think people now discounting very much. You know, we had a Ukraine war, now we have a very unstable situation in the Middle East. You cannot hope for that year to be without any crises. But we will have less political uncertainty because some of the elections will be behind us. So yeah, that should be helpful.
How does the demand for private credit actually change the multiples or how you look at private equity?
So the credit market is fundamentally changing. Some markets are still very much banked. You know, Japan, which is one of the markets which our industry is very focused on, compared to the US, has a much more bank market still. The institutional market is not as advanced. Germany, similar. Europe is probably in the middle between the US and Japan. Private credit is a significant opportunity in Germany. We have a big business here as well in it, and it's definitely helping German companies or European companies to finance themselves in a more sustainable way, being more independent of the banking market.
Philip, thank you so much for joining us today. That was Philip Freise, the co-head of European Private Equity at KKR. Now, coming up, our exclusive interview with Thomas Schinecker, the chief executive at Roche. The pharma giant talks to Bloomberg's Anna Edwards to discuss the firm's industry outlook, new drug development, and more. That's next, and this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge of the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning and welcome to the Pulse. I'm Anna Edwards in London, in for Francine Lacroix, who is with us, of course, as you just saw. She's at the Berlin Global Dialogue. More from Francine as we go through the programme. These are your top stories this morning. Dock workers walk out of every major port on the US East and Gulf coasts, threatening the world's largest economy weeks before the election. Israel says it has begun targeted ground raids in villages close to the border in southern Lebanon, despite international calls for restraint. And you're looking at live pictures from Brussels as the former Dutch Prime Minister Mark Rutte has succeeded Jens Stoltenberg to become the Secretary General of NATO. Let's move on to corporate news flow. And the Swiss drug maker Roche says it's aiming to deliver 20 new medicines to address diseases that rank among the biggest burdens to society this decade. The new goals are the result of a more than year-long overhaul of the company's research and development, as Chief Executive Thomas Schinecker targets a fresh direction after a series of failures in cancer and Alzheimer's disease. I'm pleased to welcome Thomas Schinecker to the programme for an exclusive conversation. Very nice to have you with us. Thomas, thank you for being here with us in London. I know you've been talking to investors, presenting your new plan. If I could zoom in on one area of focus, because the market's got itself very excited about the potential for obesity drugs. You are in this space. You did a deal with Carmot. What space do you think there is for Roche, given how busy it is with lots of other competition for obesity treatments?
Well, obesity will make up about 50% of the world's burden in terms of the population. So 50% of the world's population will be obese in their 30s. So that's a huge problem that we have to face as a society. The issue with obesity is that it doesn't only affect, the fact that people get overweight, but actually the problem is that it affects so many other diseases. Diseases such as cardiovascular diseases such as cancer. We know that people that are obese develop a higher chance for getting cancer. Other diseases like Alzheimer's, Parkinson's disease. So you see a big link between obesity and a number of other diseases.
And that's the urgency, but there's a lot of GLP-1s out there on the market already. You've got your own play. What space do you think there is for Roche in this?
Well, on the one hand, we have very good molecules which have a very high efficacy, and they're very differentiated. We have an oral version and injectable version. And on top, we believe that the medicines that are currently on the market will actually not serve all the needs that patients have. For example, there is a reduction in muscle mass in patients with the current medicines. So how do we fix that, right? How do we fix that people can stay at the level once they reach the level that they need to reach? Yeah. So there are a lot of opportunities to address that. And on top, co-formulations with other medicines to tackle diseases in the heart, liver, kidneys, etc. So we believe it's kind of a backbone in order to address a number of different healthcare challenges in the world.
So is this a deal story for Roche? Is this something that means you have to go out there and buy other businesses to play your role in this space?
No, in fact, when we did the acquisition, we saw that we had more than 5 different medicines that we actually want to combine the GLP-1s with. So we actually have a very more than 5 different medicines